Welcome back. Earlier today, it was reported construction spending rose for the 11th straight month in November. This is reported on MarketWatch. It rose 0.4% in November, the 11th straight month of increases reported by the Commerce Department. What we're going to see in just a moment, though, is that while on the surface the numbers look good, they actually are not. And there's a very big divergence between the different sectors within construction spending. Month over month basis down 3.3%. The weakest segment of construction spending is lodging. The strongest is residential. And this really is one of the ways we could sum up this report today. A lot of improvement in residential construction, a lot of decay in the lodging. Not only lodging, but that is one of the weaker sectors. Construction spending, by the way, can be considered a leading indicator. The money spent today on projects for tomorrow certainly can benefit us in the long term. The reason why we want to look at these different sectors is that we should consider our own investments and make sure that we're aligned with wherever the strength is. Manufacturing is up 59% on a year over year basis, a manufacturing segment of construction spending. Now, this by far, of course, is the best segment within construction spending. But what we're going to see in a moment is this 59% is actually not that good. Non-residential is up 18%, residential up only 4%, commercial up 4%. Also, we'll see residential construction 4% is good, commercial up 4%, not good. Also, lodging 5%, not good. Here is total construction. These are all the different segments put together. And then we have the S&P 500 in white and a pretty strong correlation. Stocks like to go up when there's more spending. That bodes well for corporate earnings. Now, we see here the S&P 500 is represented by the purple bars. The yellow represents non-residential construction spending, not as sensitive to interest rates. The blue line, residential construction. And certainly that went down a lot under the environment of very high interest rates. But I think under the anticipation of lower rates in the future, maybe there's more spending. And again, this is why this is a leading indicator because it looks like investors are starting to spend in residential construction spending, anticipating lower interest rates in the future, investing today for the buyers tomorrow. Now, here's a manufacturing segment of construction spending. Remember, that was the best, 59%. Well, this is what 59% actually looks like. It is the lowest increase we've seen in a long time. We were at 82% May of last year. This is the lowest increase we've seen. So again, manufacturing is the strongest segment of construction spending, but it actually is within its own respective trend at the weakest position we've seen in quite a while. We see here non-residential construction spending that's at up 18%, coming off of the highs recently of 21%. We've tried to group these charts somewhat in order from strongest to weakest. So, for example, the power utility sector of construction spending, if we have any investments in this area, they're probably doing better. Up 17%. It's one of the highest readings we've seen in quite a while, actually. Highway and street year over year, it's treading water, up 15% on a year over year basis. It's been between 13 to 16% over the past 5 months or so. Here's healthcare construction spending, up 12%, the weakest number. It looked a lot better a couple of months ago, up 18% in September. Not so much the case now. Transportation up 7.3%, a lot like the healthcare as well. It's a lot lower than it was just a couple months ago. Here's office construction spending, not really that good either. So we're seeing that while we see increases, the increases are much less substantial than they were just even a few months ago. Now, here's residential construction spending. Remember, 4% looks good in this case. Why? Because we were down 14%, a negative 14% April of last year. Well, we have improved, and I think this is smart money moving back into the residential area, the residential segment of construction spending in anticipation of lower interest rates, which hopefully will bring back buyers to the markets. Here's lodging. Now, this is not good. 5%. Now, think of lodging, hotels, it's discretionary spending. We spend the money only when we have it. Well, there's very little investment right now in lodging. Think of our own investments. Hopefully, we don't have anything aligned with the lodging industry. Doesn't look like it's faring very well. We were at 34% January of last year, year over year basis. Now only 5%. Now, commercial construction spending also not so hot at all, up 4%. That is the lowest low we've seen in quite a while. So, really, to recap, we have the strongest segment is manufacturing construction spending, but that 59%, that's the lowest low we've seen in a long time. And it makes sense given our recent reports, Empire State Manufacturing, Philly Fed. If you haven't seen those, they were not too long ago. We spoke about those. Those manufacturing numbers really were not that high. And this makes sense. Lodging, commercial construction spending at the lowest lows, barely in positive territory. One of the bright spots, though, is it looks like we're seeing a recovery in the residential construction spending. So hopefully that continues. We're, of course, going to continue to watch this very carefully and we'll report on any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.